For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Hey, let's manage your financial future. What do you say? Welcome back to the program. Johnny Dean here with Professor Rick Plum, CFP, Certified Financial Planner Professional. Still hoping I said that correctly. Welcome, Rick.
So am I.
I know. They'll correct me if that's not right. Actually, they haven't corrected me on that for a while, so I think I've got it down. Big show today. This is fun. This is fun for me because I'm sort of in this, in this particular, I'm getting close to where I need to think about this stuff.
As a recipient or a giver?
Well, on the giver side. I can't do much about the recipient side. That is what it is. When you're leaving your assets, here's the thing. You have your living trust, your will and all that set up.
Or you don't, but you're starting to think about, I've got assets that I may have left over when I'm gone. Where do they go and who should get them?
Right. And so how do I set up my financial plan so that it works best for the trust? Many times the trust person just kind of does what you say.
Many times I hope they do exactly what you say.
Well, I've heard of some that say, well, are you sure? It might be better financially if you do it this way.
Oh, you're talking about the people drafting
it
while they're drafting it. I was thinking that you were talking about the trustee. The trustee is doing what you said to do.
They better. Right.
Supposed to, at least.
Yeah. And really the person drafting the trust they may be able to say, it might be better from a tax standpoint to do it this way, but they don't all do that. And I would actually prefer my financial advisor to tell me this stuff.
Or coordination with the two of them.
Coordination with two of them is good. It doesn't always happen. But, you may have set up your trust a long time ago. Who knows? So we're going to talk about this here. And I'm going to run down some assets that somebody may have.
Okay. But there's lots of different types of assets.
Yes.
And how the beneficiary is taxed or how they're treated varies depending upon what is being passed down.
Yes. Very much so. And oftentimes when you're passing your assets down to the next generation, kids, let's say, they're in a higher tax bracket than you are, maybe.
At the moment.
Could be.
Maybe when you're retired, your income has gone down, and with the fact that Social Security is not taxable, at least not in most states, it's not 100% taxable even at the federal level. Maybe your income is lower than your kids who may be in their peak earning years. And so you may want to take a look at that. Now that we don't have stretch capabilities for kids, they've got to take it out all within 10 years, which may be in their highest working years.
It may be. Now, as happy as they might be to get whatever.
They should be happy to get anything they get.
Yeah.
But how do we make it as efficient as possible?
Correct. So let's run down some of these things.
Keeping the federal government from being one of your beneficiaries as well.
Well, yeah. Now you could be talking about, from your standpoint, you could be talking about estate taxes, which don't affect a ton of people.
In a couple of years, it might affect more people with the run up in real estate and things that have happened over the past couple of years.
You never know.
When the Tax Cut and Jobs Act sunsets, the current high estate exemption limits sunset as well.
Yeah. Go back to what?
$5 million apiece.
Okay. So $10 million.
Still, $10 million between a husband and wife.
What do you bet they come up with a way to fix that one and then leave the rest of us?
We'll see. But but that bringing it down from roughly $26 million down to $10 million for a married couple.
It will affect some people.
It'll affect more people than it does right now.
All right. So somebody's got. Let's group some of these things together. This is a common thing. People have, let's say, some safe-ish money, cash, CDs,
in their name or their trust name, not in a tax-deferred account.
Well, this is what a person who is setting this up. Let's say I'm getting ready to meet with my estate planning lawyer, but I'm meeting with you first to see. Well, okay, obviously all this stuff, there's no trust yet. So let's. What do I do here? I've got. Let's start with the cash CDs, and I'll put bonds in there too. What should I do with those? I'm going to meet, right after we're done with my estate.
So you have personal ownership of bank accounts, CDs, brokerage assets.
Yes.
Typically, with the exception of maybe your checking account, you're going to put anything of sizable nature of, anything you're not using on a day-to-day basis, signing your name to on a day-to-day basis. Although I don't know how many people write checks anymore, but
my wife still does, but whatever.
Those would be in the name of the living trust.
Okay, so I am going to put, other than my usual check writing,
right? Usually, you keep a check. I mean, a checking account. How much cash? I mean, now I do find people from time to time that have $150,000 of cash at their checking account, earning absolutely nothing.
All right,
and we try to help them with that situation, but because they don't spend $150,000 a month.
No, let's say they've got roughly
less than $10,000 in their checking account.
Yeah, well, they might be bucketized here, right? And
well, hopefully they're bucketized in the first place, but yes.
So they've got maybe 100,000, and I'm just throwing out
bucket number one, and so that's laddered out. Yeah, but that's not my checking account. That's not my daily checking account.
No, that's we'll call that your savings. These are all part of your
the savings
portfolio.
Basically transfers money to your checking account on a monthly basis or a biweekly basis as your paycheck, basically, in retirement.
Exactly.
So the savings, your personally direct owned brokerage, those all are going to be changed to the name of the living trust.
Okay. So cash, CDs, bonds, the stuff that's in your brokerage account, that should all be part of that. Those should be put inside the living trust. Okay.
Right.
Now,
the idea, the purpose for the living trust is to avoid probate when you pass away so that the assets can transfer from your ownership to your beneficiary's ownership with as little interference from outside sources, probate, as possible. And so that's the main reason for what we're talking about a living trust here, because we're talking about passing assets on to future generations.
Okay.
So the living trust allows to avoid the probate process.
So let's say the kids, and I've also got charities I'm going to give to, but let's leave this alone. The beneficiary or the
let's talk about, you were talking about the accounts first. I mean, who should be the owner and beneficiary of the accounts? I mean, I guess, yes, you do need to know who ultimately is going to receive the money.
Well, are there tax consequences to, let's say, the kids, first of all? I know if you give it to a charity, there's no tax consequences for them. But what are the tax consequences for them to receive cash, CDs, bonds, things like that?
Direct ownership, if I have stocks, cash, CDs, treasuries, things of that nature, bonds, there's no income tax consideration when it transfers from my parents to me, or from me to my kids, or from one generation to the next. Let's go that way.
All right.
The only potential tax liability would be, mom and dad die, and they have an asset that's worth $100,000. They paid $10,000 for it, back in 1986, and now it's up to $100,000.
Okay, we'll get to that. But yes,
but the only tax consequence is not the gain that was in it before death. But if I wait a while and sell it for $120,000, then I would be responsible for the tax on the $20,000
after you've received
the date of death.
Okay, so brokerage
minor.
account.
I mean, very efficient income tax, transfer in that position, where it transfers from one generation to the next. Direct ownership of brokerage type assets, CDs, cash, and savings.
Okay, good. Yeah. So all of that stuff passes without tax considerations.
Without income tax for the most part, yeah.
All right, and we'll come back to the brokerage account again. Let's say I've got if I've got a home.
A house is a capital asset?
Yes, and let's say I paid $100,000 for it 30 years ago, and it's now worth $500,000. I don't know.
That's a capital asset, and under current law, capital assets are, they pass fairly easily if you have them in the name of the trust.
Which a home should be, I
That's
assume you're
usually the reason that people do a trust, because that's their biggest asset. And in most states, probate is based on the current value, not the current equity, but the current value. So you may have $1 million house with $950,000 of debt against it. You don't have a $50,000 asset for probate. You have $1 million asset for probate. And so they will charge you accordingly.
All right, so the home should go.
The home should be in the trust.
Now, what happens when it passes to your heirs?
They can do anything they want with it because it receives a new tax basis, based on the value on the date of your death.
So if I bought it for $100,000, let's say now it's worth $1 million. I had a huge gain.
It's as if the kids who inherited it paid $1 million for it the day you died. So their purchase cost, basically, their basis, is the value on the date of your passing.
So they inherit the home and they sell it right away, let's say.
No tax.
and there's absolutely
no income tax.
They get to keep the profits from that. Not a bad deal.
No, that's a very good deal.
It's what they call step up in basis, which helps from both stock standpoint.
Any capital asset that's held directly, either direct in my name or through my living trust.
All right, so that's a pretty good deal for them, inheriting the home.
And we see this a lot where people want to pass on a house and they say, well, I'm just going to change owner. I'm going to live in it until I die, but I'm going to make it easier for the kids. I'm going to change the ownership from myself to my kids right now before I die. And so they take that $1 million home you were just talking about with a $100,000 basis that I paid for it 30, 40, 50 years ago. And I change the ownership to my kids. And then a couple years later, I die. Well, guess what? There's no change in ownership or basis at that point because the ownership changed 3-4 years, however many years before. And now the owner of that property didn't die. The owner is my kid.
Yeah, I
died, but I'm no longer the owner.
You should have allowed them to inherit the home.
If possible, in many cases, it's better to hold on to that particular asset, especially one with a large gain like that.
Yep, a mistake that you've seen happen
quite often,
more than once.
And it doesn't necessarily make it any easier for the kids if you would have just put it in a living trust and maybe named them as trustee. They had the ability to sell it outright anyway, right after you passed away. Either way.
Tax-free. Okay, now I've got a couple of IRAs. I've got a traditional IRA and I've got a Roth IRA. Let's start with the traditional IRA. What do we do with that? Let's talk about things with beneficiary designations, but you know where I'm going with this.
Well, as far as the living trust, in many cases, we're obviously not going to change the ownership of the IRA to the living trust. That becomes a taxable event while I'm alive, and I really am trying to avoid that.
Yeah.
But so when we have a beneficiary, the reason to use a trust is if I have problems with the ability of the beneficiary to maintain and manage money. So if I'm worried about, dropping a couple $100,000, $1 million of assets onto my beneficiary's name and giving them total control over it right away, that they may, maybe they have issues that would be health threatening even for that matter. I've seen the main reasons are addictions and things of that nature. Or I've seen this more than once. I want my son, daughter to receive the money, but I don't want their
spouse,
money grubbing spouse, either way, to have any access to it. So if control is an issue, then using the trust to inherit the IRA, assuming you didn't just name the same kid as the trustee.
Don't do that.
But typically, if you have a named beneficiary, it goes directly to them. It avoids probate. So if the main purpose of the trust or only purpose of the trust was avoiding probate, not for control, then naming the kids directly as beneficiary can make their life a little bit easier after you're gone.
So in other words, if you don't have control issues once you're gone with the money, then don't bother putting the IRAs inside the trust.
Yeah, name
them as a beneficiary. But if you do have control issues,
if you need control issues, if
once
the
you're
child
gone,
or the inheritor,
then
the trust is more important than the tax issue.
Kids have inherited. Well, okay. So let's say traditional IRA, Roth IRA. Let's say they're going to the kids.
If I take money out of a traditional IRA, I have to pay taxes on that traditional IRA distribution.
As the owner.
And now when my kids inherit it, they still get to pay taxes on it. It's now their tax liability, not mine. So in a traditional IRA, you cannot get rid of the taxation of the traditional IRA just by dying. Unlike that capital asset that was in your name directly, like the house or a stock portfolio or whatever the case may be, with a capital asset held directly. If I die, the built-up gains in there are wiped out. With an IRA, nope. The tax is it's still a taxable event when the money comes out of that IRA.
In many cases, you on a traditional IRA, you may have a zero tax basis, in which case all of it is taxable. There may be post-tax money.
And this is the problem with after-tax contributions because maybe you've made after-tax contributions. You know how much is in there. You've filled out your 8606.
Your heirs
but your beneficiary didn't know that. Yeah. And so they end up paying tax on the money when it comes out that should have been tax-free because it was after-tax money, unless they're very aware of what to look for in your tax return, which you've probably never shared with them, and they may never look at after you've passed away to look for that kind of thing.
So if you have
after-tax money in your IRA, make sure somehow you put a note to your beneficiaries that look at the tax return. There's an 8606 form in there. Don't pay tax on it twice.
Don't pay tax on this amount. Some of this has already been taxed.
Correct.
Yeah. Okay.
Now, the good news is the other type of IRA, Roth IRA, if it is a tax-free distribution to me as the owner, It'll be a tax-free distribution to the beneficiary as the inheritor.
Even if they don't have Roth. There's no 5-year rule with that.
Well, the 5-year rule was on the account. So if I'm getting tax-free distributions, that means I have satisfied the 5-year rule.
Yes.
And which means that the inheritor, they've already satisfied the beneficiary 5-year rule because I satisfied it.
If you hadn't satisfied the 5-year rule, do they need to wait?
Yes.
However more years it is until you hadn't been in
let's say you opened your Roth IRA for the very first time towards the middle of 2021 or 2022 at the bottom of the market, and you bought something and it doubled since then, and it went from 120 to 220 or something. So I put in, I converted $100,000 and now it's worth $200,000.
They have to wait.
The 5-year clock started the year I did this was my first Roth IRA in this example, and therefore somebody has to wait the 5 years to be able to take out the growth tax free.
Okay,
the 5-year rule with this IRA still has to be met.
But it's important that you understand this before you do your trust. Now
with most inherited Roth IRAs, since unless you're what's called an eligible designated beneficiary, but most people, especially kids, are going to be designated beneficiaries. It means they're going to be subject to the 10-year rule now.
In other words,
no distributions years 1 through 9 after the year of death.
You mean are required?
Are required. You can take as much as you want, but you have to have it completely exhausted by the end of the 10th year of the anniversary of death.
It has to be out of the Roth.
Right, out of the Roth. So if I'm going to get tax-free, I might as well leave it in there for the longest I can.
Assuming you don't need it.
Yeah, assuming I don't need it, to get as much tax-free growth out of it as I can and take it all out in the 10th year.
Roths are cool.
So Roth is different than a traditional IRA, and the required minimum distribution rules are a little bit different for a Roth than they are for a traditional IRA. So these all come into play, and they all come into how do we determine who gets what when I'm going to be gone.
Now, let's throw in this. I've got a charity I want to give money to, okay? And let's say I've got $100,000 in a traditional IRA and $100,000 in a Roth. I'm just making these numbers.
And $100,000 in a CD.
In a CD.
Or a brokerage account, personally.
So I say, well, I want $100,000 to go to a charity. I got $1 million total, but $100,000 of this I want to go to the charity. So, gee whiz, I don't know. Maybe I'll give the Roth to the charity, and I'll give the traditional to the kids. What's wrong with that scenario?
Well, what we've seen is common is that people make the bequeath, whatever you want to call it. I can't remember which one's before and after.
Bequest is the noun. They bequeath is the verb.
That's that English thing, right?
I understand. Yeah.
I want to make a gift.
There you go. Better.
So I put it in my trust to give $100,000 to the charity because I'm feeling, that the money goes through my trust, right?
Sure.
But the IRAs don't go through the trust necessarily. They go through the beneficiary. The Roths don't go through it. A non-qualified annuity don't go to the trust. They typically go to the beneficiary unless you've named the trust as a beneficiary. Now, you screw up the required minimum distribution rules if you name the trust as a beneficiary and you have individuals and non-individuals, a charity, listed as the beneficiaries of the trust. So you've got to be careful of those situations. But in that case, what's going to happen is, then I'm going to name my kids as the beneficiary of the IRA. So the $100,000 comes through my personal assets and goes to the charity, and my kids get the IRA. From a tax standpoint, that is completely backwards and should be changed around. Name the charity as a beneficiary for the $100,000 IRA. Traditional IRA. Give your kids the Roth and the money in the estate. Why? Because if I'm inheriting money through the estate that is not IRA money, then I don't have to pay any taxes on it. If I'm inheriting an IRA, I have to pay taxes on it. If the charity inherits money from the estate, they don't have to pay any tax on it. And if they inherit money from an IRA, they don't have to pay any taxes on it. So by naming the IRA as the charity as the beneficiary of the IRA, the only entity losing out here is Congress. They're not getting the tax dollars, which fine by me. But my kids get a more efficient distribution. The charity gets the same distribution either way. Yeah. They get the $100,000.
Yeah, it's a mistake that I'm sure you've seen.
Oh, I've seen it in multiple different levels of income too. I've seen people with $8, $9, $10 million who were giving their kids all the IRAs, and they were making fairly large, $1 million, gifts out of their estate,
right,
with cash. I was like, no, let's change this around.
Change it around.
Now they didn't have any kids, so it wasn't as big. They were giving their estate to nieces and nephews, but they still cared about them. They still wanted them, they cared about them, and the charity a lot more than they cared about the IRS.
Sure. Yeah. If you want to do it so make sure you have that set up that way.
Look at who, and the first thing, who do you want to receive? How much do you want what of your assets to go where? Who are you wanting to pass your assets to? If a charity is involved, if a non-entity, non-individual is involved, let's do some estate planning and let's do some beneficiary coordination with tax law so that you make it as efficient as possible. It obviously isn't going to affect you. You're dead. It's not going to affect the charity. They're going to get the dollar amount either way. But it does affect your own kids depending upon which assets you pass down the ladder to them.
Very important stuff, folks. Very important stuff. Okay, so let's move along to, I have a 401k. Let's say I have a decent-sized 401k.
Same
now,
as the IRA.
In many cases, it's exactly the same as the IRA, yes.
Yes, and when we're talking about the different types of accounts, there's basically three-ish, basically. There's your direct ownership personal assets in your name, your or your trust name. There's Roth money. Whether it be Roth IRA or Roth 401k, it's Roth money. And there's traditional tax-deferred retirement accounts, 401k, profit sharing, things of that nature, and your traditional IRA. And then there's one more category out there that is kind of a it's a non-qualified, personally owned annuity.
And that was going to be my next
deferred annuity.
That's my next asset to throw out. So we say 401k is
it's good to go to charity, and depending upon
you use a beneficiary designation for that 401k.
The IRA, the 401k
that does not go in the trust.
The tax deferred accounts, the traditional Roth accounts, and annuities all have beneficiary assignments with them, and so you want to put a beneficiary on those. And the reality is, real estate nowadays, you can have a beneficiary on them too through a trustee deed or some kind of beneficiary deed. Every state has one. They call them slightly different names. But so you can pass things by beneficiary. The question is, A, should you? And B, how do we set it up and who should be the beneficiary? So when I talk about the tax-deferred accounts, we're talking about traditional 401k, traditional IRA. Roth accounts, we're talking about Roth IRA, Roth 401k. I'm kind of grouping them together in this area. Mm-hmm. Brokerage is personally owned, and then non-qualified annuities. And so who you leave that non-qualified annuity to depends on how much growth.
Explain non-qualified annuity to people who may not know what that means.
A lot of annuities are purchased inside of an IRA. They're purchased whether inside of a traditional or Roth. The rules recently have become more favorable, so you could potentially own them inside of your 401k even. But typically, a lot of teachers tax sheltered annuities, TSA, 403B.
Yeah, they have
those are annuities.
Yeah.
But so there's a lot of annuities that are purchased inside of IRAs. And I actually, if I'm looking for the most part, depending on the circumstance, I like putting annuities inside of IRAs. I'm not worried about the tax deferral. Obviously, I'm losing the potential tax deferral of owning it personally, but I'm buying it for the bells and whistles, not for the tax deferral. But people do buy annuities in their personal name. I was talking with somebody just the other day. In like 1993, they put $50,000 into an annuity. Obviously a few years ago, 30 years ago. Now it's worth $500,000. So if they were to take any money out of this annuity, they have to pay taxes on all of that deferred growth. They've never paid any taxes in the annuity, obviously, because it's tax deferred. They put in 50. It's earned interest. It's earned out.
So it's got a $50,000 basis.
It's got a $50,000 basis and a $450,000 deferred gain. That deferred gain is going to be taxable to somebody someday if a individual takes the money out of it.
Well, let's say the kids get that annuity.
The kids have, very depending upon how they do it, they don't have the same options as an IRA, so it's a little different. But they're going to pay the taxes on that $450 when it comes out.
Does it come out pro rata? Does it come out, is
depends.
It FIFO or LIFO?
It depends. Because we can do stretch on that.
Gosh. All right.
and blend it like it. You see now we got to talk about the taxation of distributions for annuity. Are we doing an immediate annuity? Are we doing a systematic withdrawal? But yes, we can. Although you may not want to. So, whatever the case may be, that $450,000 is going to be taxable.
All right. So if you have an annuity and you're doing your estate planning, you have to understand talk with your financial advisor about what type of annuity you have and what are the tax consequences potentially of your kids inheriting that.
Now, for some people, and this is what I've talked to some people about recently, they have maybe a $150,000, $200,000 annuity that they started with $75,000 or so. Still a lot of gain. But what they can do with that is there are long-term care products that they can use. And so they take that $150,000 annuity that is half gain. So if they were to take any money out of it, that first 75 coming out of it is taxable, and they can't get to their original 75 until they've gotten rid of the gains. But if they put that into an annuity that is a long-term care annuity,
it's one of those hybrid.
It's a
types
hybrid
of,
long-term care policy.
Yeah.
It's a tax-deferred exchange, so I don't pay any tax on putting the money in. And assuming that I qualify, which is for most people somewhat easy, it's not perfect for everybody, I get $450,000 of long-term care, and that covers quite a bit of long-term care. And so if I go into a nursing facility, home health care, need it, if I satisfy the 2 out of 6, and I start getting distributions from this annuity for that $450,000, I'm using up that gain in the annuity. Maybe I'll use up all $450,000, and it's tax-free.
They give you the tax break.
They give you a tax break.
Isn't there a limit how much it can use per year?
Yes. You can't just use $450,000 in 1 year in that example. It's spread out over a couple of years.
That'd be a pretty expensive nursing facility. But.
Well, $450,000 would be, yeah. But but you can buy enough. I mean, you can get crazy. I don't think you should, but for people that have these tax deferred annuities that they probably don't need in the rest of their life, if they don't need it, and they're worried about long-term care, this is a great way to potentially avoid the tax on that gain in the annuity.
So as we wrap this up, of these things, would you say is the easiest thing to inherit would be things like CDs, cash, brokerage accounts, bonds?
Easiest,
like
yes. Most tax efficient would be the Roth, but you have to worry about the 10-year payout.
Sure.
The other ones, you don't have to worry about anything. IRAs, the least efficient. You still have a 10-year payout, and it's taxable. Annuities, even more complicated, personal annuities. So who are your beneficiaries?
If you want to, could you leave your, if you want to just keep it simple, could you tell your estate planning person, or you just say, look, I want my annuity to go to the charity.
Sure.
And then nobody has to worry about any tax consequences.
Yes, it's just like an IRA in that case. And when you say, I want it to be simple, simple for who? Simple for you or simple for your heirs?
Well, you'd like it to be
simple for you. You don't have to do a dang thing.
No,
it's not going to affect you at all.
No, it's not. So obviously simple for your heirs, most tax efficient way and the simplest way to do it.
Let's identify who our heirs are. If they're all kids,
or just
then we have to
people.
And then if they're all kids, then we decide, well, do we have one that's making like $1 million a year and one that's making $50,000 a year? And maybe one should get the Roth and the other should get the traditional IRA? Do we split those kinds of things? And also when we're looking at heirs, this comes into the question of Roth conversions. Should I be converting my traditional IRA now so that, because my kids are in a much higher bracket than I am, so I could pay the tax at a lower level than they do? Or does this all comes into play when you're dealing with your financial planning and your conversion tactics, your tax tactics. That's not easy to say.
Tax.
Yes. Your tax planning.
Your tax.
All of this comes into play.
Well,
and your required minimum distributions. Am I bringing down my IRA through conversions to avoid the RMDs, or am I doing it to do from a purely tax standpoint? And it's not just my tax situation, it's my heirs' tax situation I'm looking at as well.
Yeah, that's why you got to have your heirs involved in your financial planning.
I think so.
I think it's very, very crucial. And with your estate planning. It's not just a bubble.
We've also seen that when heirs are involved and they understand what's going on, they get a little bit better feel for it. They're less likely, I'm not saying it's going to happen every time, they're less likely to go out and blow it the day they get all the money.
Very important. All right. So, Professor, thank you so much.
You're welcome.
This is wonderful information. If you need guidance on this kind of stuff, make sure that you talk to your financial advisor and coordinate with your estate planning person when you're putting a trust together. Very important. And I can't emphasize this enough. Have your kids involved. Sometimes parents don't want their kids
taboo. You don't
to
want to
know,
talk money with your kids.
It's none of their business, But it really is their business, and it's your business. Have them meet with you and your financial advisor. Professor, you see this a lot, right?
Well,
people bring in their kids.
Right, we do. And the ones that don't, unfortunately, excuse me, they pass away. The kids don't even know where the money is.
Yeah, you're right. Like they choke to death on something.
Yeah. It's a good one. And it's a matter of, we don't even know what mom and dad had.
Yeah, don't do that. And I say this.
In the old days, we could wait for the mail for a statement to come in. But now most of the mail goes to an email, and their statements go to the email. And so the kids can't even wait for the mail because they don't have access to the email.
Because you don't know the passwords.
Yeah.
Coordinate with your advisor. If you want some more help with this stuff, Professor Plum and the folks at Lucia Capital Group coordinate this all the time. Make sure you do that. 800-644-1150. Give them a call at Lucia Capital Group. If you haven't met with your advisor with your kids as you're getting older, it's probably time to at least inform them, let them know what's going on so they know all about this planning stuff. 800-644-1150. Go online, find a lot of this information at luciacap.com, LUCIACAP.com. And, of course, subscribe to this here podcast. Very important. You didn't want to miss today's program, and you don't want to miss all the others either. Go to you can do it at iTunes or Spotify, and make sure you listen to every single episode. Again, Professor, thank you so much.
You're welcome.
For the Professor, Rick Plum, I'm your podcast host, Johnny Dean. Thanks for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It's important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Long-term care coverage policies and provisions may not be available in all states. Approval may be subject to the terms and conditions of the insurance company. Insurance product guarantees are subject to the claims-paying ability of the issuing insurance company and are subject to their terms and conditions. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.